So this week's market outlook is not going to spend any time talking about the Fed or the economic data that happened last week because I don't think any of that matters at this point in time. After Friday, after SIVB was seized by regulators, Silicon Valley Bank was seized by regulators, that became the only story, and that is the only thing that really matters at this point. Second largest bank failure in U.S. history. I think they were 16th in the U.S. in terms of size. So it's going to be important to see what happens before the market opens on Monday, because this does have the potential for a contagion effect. Not because this organization owes another organization money and they're going to fail, which causes another organization to fail, but because of confidence. And that's exactly what brought this bank down on Thursday, was depositors reacted negatively to the bank's plan to rebalance its balance sheet and started withdrawing money. And that was the beginning of the end. Less than 24 hours later, it was all over. Nothing will take a bank down faster than depositors showing up saying, "I want my money back." It's the kiss of death. So the question before the market opens on Monday is what are regulators, the Fed, the Treasury, the government going to do to restore confidence in that sector? Because this does have a spillover effect. And it's not because A owes B money and B will fail, but because the clients of B will feel that, well, if it can happen to A and it can happen out of nowhere, no one expected this, and all of a sudden there it is, I don't want to wake up one morning and find out the same thing is happening here. Anything over 250, I'm not protected on, so let me get that out of there. So that could cause other banks to experience this kind of effect as well through no fault of their own. So it's important that we understand a little bit more about this. And so what I've done is, I had never heard of SIVB before this happened, so I had to do some research and some digging around. And what I've put together is based on stories that I've read from different sources, all with little bits of information that were slightly different. I've extracted the bits of information that everybody seems to agree on, and then I used SIVB's mid-quarter update, which they released Wednesday night. It was a PowerPoint presentation along with a letter to shareholders. I used that along with their December 31st SEC filing to try to put together the best picture I can about what happened. And this is particular to this bank, but it highlights what I've been talking about when it comes to this kind of thing, that usually when trouble shows up, it shows up all at once, and it'll show up from a place that nobody expected it to show up from. And that's usually the beginning of something, is it'll come from some place that nobody expected. So we see delinquencies rising for subprime auto loan customers. Well, duh. You see commercial real estate, especially office properties, having some credit issues. Well, that's probably expected. Nobody expected this. That's the thing. It's the unexpected, something that comes out of nowhere that causes a crisis of confidence. It's the crisis of confidence that's the problem. You can do an autopsy on SIVB for the next week and do a case study about the lapse in risk management that they had in place, and they did have a lapse in risk management in place. I've heard some commentators talk about this is all the Fed's fault. The Fed caused this. SIVB was going along, minding its own business, doing all the right things, and suddenly, out of nowhere, the Fed did this thing. That's not true. That's not true. Imagine that you're a subcontractor building houses, and we'll see how this was management's issue here. Imagine you're a subcontractor building houses, and the weather authority says, look, you got a tornado heading your way in about 48 hours. You got to get out of there. And you say, we're good. And you keep working. You don't secure any of your tools. You don't lock down any of the lumber, any of the bricks. They're all just laying there loose. And the tornado comes through and destroys everything and kills some of your people. And somebody comes along and says, wow, this crew was minding its own business, and all of a sudden a tornado came through and destroyed everything. It's not the company's fault. It's not management's fault. It's the tornado's fault. Yeah, but they saw the tornado coming. It's part of the landscape. These are risks in the environment that you have to live with. Well, banks have risks in the environment, and the more concentrated, the more specialized, the more regional you are, the more you have to be aware of those particular risks. You have to know your client. And while they knew their client, they didn't seem to take much effort to manage the risk of the type of client they had. So let's begin with a timeline of how this all came together, because when these things happen, they happen quickly. These things, as I've said before, bad news doesn't get drawn out over a period of 5-6 months and everyone sees it coming. It shows up all at once. So last weekend, or before last weekend, which would have been the 4th and the 5th, Moody's lets SVB know that it intends to downgrade its debt. So there's a pending downgrade coming. So what management does is gets into action. They want to avoid something called a multi-notch downgrade. So if they can rebalance their balance sheet, they might be able to survive a single notch downgrade, but they don't want a multi-notch downgrade. So their plan was to sell $21 billion in securities, and this came from their securities portfolio classified as AFS, available for sale. On the next screen, I'll explain what that is. They were going to take a loss, an after-tax loss of $1.8 billion, but they figured, and that's going to affect equity right away, and banks need to preserve equity ratios. So they'll cover the loss with an equity sale of $2.25 billion. $1.25 billion was going to be common equity, $500 million was restricted stock, and $500 million was going to be in convertible preferred shares. And this looked like it was well underway. The private placement seemed to be in place. Everything seemed to be fine. Tuesday, Moody's informs SIVB their 24-hour window to downgrade, which is sort of a courtesy that the credit rating agencies give the target, is they'll give them a 24-hour notice of when they're going to release the downgrade. So now it's done. It's a done deal. Wednesday after the close, Moody's is going to release its downgrade. So SIVB, Wednesday after the close, front runs it. They announce their share sale. They release a 34-slide PowerPoint presentation, which starts off about, look how wonderful we are, look how great we are, look at the wonderful things we're doing, look how strong our position is, everything is fine. We plan to do this little thing. We're going to sell some securities, we're going to take a loss, we're going to issue some, but everything is fine. Look what we're doing, look how we are compared to other banks. So they stuck that thing right in the middle, led off with, everything is fine, but we got this little thing going on. But everything after that will be fine, and hopefully that would help it. Moody's then downgrades one notch, citing what they plan to do, saying, well, okay, so they're going to do this kind of stuff. They're going to sell some of the available for sale and do some of this. We'll downgrade them one notch. Thursday morning, the stock plunges more than 60% on that. Just drops. This is what spooked the depositors. This on its own, all up to here, would have been okay, I think, if the stock didn't react so negatively, but it plunged about 60%. That spooked depositors, which started a run on the bank. Is you got to get your money out of there. You got to get anything over $250,000 out of there, and most of their clients, based on their presentation. A large chunk of their clients were venture capital backed firms that had their Series A or Series B money sitting in there, 50 million, 60 million, 100 million, whatever the case was, and they all have burn rates, so they needed to get that money out on a regular basis, payroll being their biggest one. Just on Thursday alone, 42 billion in requests to withdraw, 42 billion. And that is roughly about 25% of all customer deposits in one day. By Thursday afternoon, the share sale was called off. It wasn't going to do it. At this point, it wasn't going to do it. And for the 500 million private placement, they couldn't get the commitment in place in time. So going into Thursday morning, it was still pledged but uncommitted. Once it's committed, it's a legal obligation. It was pledged but not committed. So that pulled out. The whole thing fell apart by Thursday afternoon. Before 9 a.m. Pacific time, which is before noon New York time, the regulators had seized the bank. So their shares were halted. And before the bank could open at 9 a.m. California time, regulators came in and seized the bank. That's how quickly it happened. They made the announcement Wednesday afternoon. Thursday was a complete shit show, and Friday they weren't even allowed to open. Some of the customers that had money there, Roku had 26% of their cash there. Roblox had 5% of their cash. Bill.com, $300 million in cash and $370 million of client funds. Circle, $3.3 billion. They're I think stable coin, and because of that 3.3 uninsured, they broke the link. There's some link that's broken between the funds that are backing stablecoin and the value of stablecoin. So there could be some fallout with these particular companies as well. Not to mention the hundreds, if not maybe in the thousands, of startup companies in Silicon Valley that are going to have a difficult time meeting payroll in the weeks coming up. So it's going to be interesting to see what happens there. Our venture capital firm's going to step in and say, okay, well, let's set up some bridge loans. Here's the sort of, timeline that'll be followed, or not timeline, but of the recovery rates is a better way to say it, that would be followed. The regulators are saying about 98% of customer deposits look like they can be recovered. That seems aggressive, considering you would have to sell off the held-to-maturity portfolio, and there's some significant losses in there. Plus, you have a bunch of assets that are in loans. I don't know how you're going to sell that, but they think 98% over time. Moody's is saying it's more like 80 to 90% can be recovered. And as of 5:02 on Saturday, a headline from Bloomberg showed up on my iPad saying that some banks and funds are offering 60 cents on the dollar for customer deposits to get them their money now. So if you had 50 million in there, they're willing to give you 30 million in cash today if you got to keep operating. Because if you got 50 million, you're not going to get it. Not for some time, because you have to get through the process. The regulators probably trying to sell it this weekend. Selling it would be the most obvious thing to do and the easiest thing to do, and I think they'd like to sell it. It's a question, well, who's going to buy it? Knowing that it has negative equity at this point, what would you buy it for? $1? I mean, that's all you'd really pay for it, because it has negative equity. You're not actually buying anything, because these are all financial assets, financial liabilities. Once you cancel it all out, you have negative equity, which means you're buying it for the going concern goodwill of it. Well, even if somebody buys it, and it has to be somebody significant enough that if they buy it, it stops everybody from leaving, so that the core of the business stays in place. I mean, that's the only thing, right? So unless you hear something before the market opens, Monday is going to be an ugly day. The regulators, the Fed, the Treasury, whoever, they got to get in front of this, and they got to say something, because if they don't, there will be more of these. Okay, I'm going to see if I can describe at a very high level what happened here, and we will see that it really is a story of a contracting firm continuing to build houses in front of a tornado that is coming. And for the Applied Series subscribers, we will go through Monday. The video will be up because, well, IT doesn't work on weekends, so it'll only be posted Monday. But under the Applied Series Extras, we'll actually go through the PowerPoint presentation they put up Wednesday night, and the shareholders to letter, the letter to shareholders. that they put up. But I'll describe at a very high level what business a bank is in terms of how it manages its balance sheet. Because on both sides of the balance sheet, it has interest rate securities. Its assets are interest rate sensitive and the liabilities are interest rate sensitive to different degrees. And what you want to do is you want to try to balance the sensitivity of your assets with your liabilities. And as I've said before, sensitivity is measured by something called duration. Duration is a sensitivity. It measures the percentage change in the price of something for a change in yields. So we know that the Fed has been raising rates, so as rates go up, the value of securities go down, especially fixed rate securities, they drop in value. So banks have a particular job that they have to manage, which is called the duration mismatch between their assets and their liabilities, because their liabilities tend to be customer deposits, which have no interest rate sensitivity. They have a duration of 0. And then when they take those deposits in, they got to put them in assets. Well, their assets tend to be loans or mortgages, longer term loans and mortgages. To manage the interest rate sensitivity of those, they can make them floating rate. So if a bank is in the business of lending to businesses, they can make floating rate loans. With floating rate loans, as interest rates go up, the loan tends to stay very close to its par value. If they make fixed rate loans, like in mortgages, the value of the mortgage drops. However, here's the thing now. If the bank has the intention to hold that loan to maturity, then all it is an unrealized loss. That the economic reality of that loan is that it's not going to be lost. That everything is going to be fine because they plan to hold it to maturity. So let's say you buy a 5-year bond and interest rates go up. If you wanted to sell that bond tomorrow, you'd take a loss. But if you say, no, you mistake me here. I have no plans on selling this bond. I bought it with the full intention of holding it to maturity. Under those conditions, GAAP allows you to classify that as an HTM, a held to maturity security. Because your economic reality is that you're not going to take a loss on it. You are going to hold it to maturity. So you get to amortize that bond to par over time. Regardless of what the fair value is, you list it on your balance sheet at amortized cost. So if you bought it at a discount, each year you write that bond up towards par because at maturity you're going to get par. And that's just a way for firms that have the intention and the ability to hold a security to maturity to avoid having all of that income statement volatility with changes in prices. If your intention is not to hold it to maturity, it is called an AFS, available for sale, and you will list it at fair value. So that at any given time, investors can look at it and say, well, these are the ones that you plan to sell. That's the fair value. That's the recoverable amount as of today. For the held to maturity portfolio, we get it. You're holding it specifically for the cash flow that those securities provide. The coupon payments those securities provide. You have no plans to sell them. We can see what the fair value is because you're telling us what the fair value is. You're telling us what the carrying amount is and what the fair value is. So we can see the difference, but we get it. You're not really selling those. Any loss, any deviation from carrying value to fair value shows up in something called other comprehensive income. This shows up on the income statement. Okay, with that being said, let's look at what Silicon Valley Bank had, and this is as of December 31st, 2022, based on their most recent filing. Liabilities, 195 billion. 166 billion were deposits with a duration of 0, no duration, which means as interest rates rose, that did not lower the value of those deposits. And we'll look at some of their disclosures shortly. Add to that they paid higher deposit rates to attract business on their deposits. So some of their deposits, if they were in what are called operating accounts, these are accounts that their clients use to pay bills, paid no interest. But if you got 50 million from your Series A round sitting in the bank, you might have 5 to 6 million in your operating account. The rest is in another account. Well, those accounts paid interest. 85%, the 166 to the 195, 85% of liabilities were deposits with a duration of 0. And they were primarily, 70% of their business was the venture capital industry, either VC firms or their client or their portfolio companies, 70%. So they had concentration risk and a duration mismatch between the duration of their liabilities and the duration of their assets. So they took all of this money and they bought securities. Securities with no default risk. There's this idea that, or I think this lazy statement going around that says that they were in risk-free securities. No. They were not in risk-free securities. They were in default risk-free securities. But a 10-year treasury or an agency MBS has risk. It's called interest rate risk, which gives you price risk. So they're not risk-free in the sense that there is no risk. They're default risk-free. Well, because they paid higher deposit rates and they took most of the deposits in before interest rates started going up, they couldn't put their money into very low interest rate securities. In other words, they couldn't match the duration by going into 3-month and 6-month T-bills because it wouldn't have generated enough to pay the higher deposit rates, so they stepped out on the maturity. And they bought longer-term U.S. Treasuries and MBS with duration risk. So they had assets with a higher duration than their liabilities. As of December 31st, 2022, their held-to-maturity portfolio had a $15 billion unrealized loss. They have $211 billion in assets, $195 billion in liabilities. I gave them $16 billion in equity, $15 billion of that 16. If these were actually available for sale, their equity would have been about $1 billion. They would have been underwater on all their required ratios. On all their Basel III ratios, they would have been underwater immediately. In fact, they would have been underwater well before the fourth quarter of 2022 if they were all classified as available for sale. But these were classified as held to maturity. So they had U.S. Treasuries, coupon-paying bonds. Whenever you have coupon-paying bonds, you're going to have duration. And they had MBS. Now, here's the thing about MBS, which makes it even worse. It has negative convexity. Well, what does that mean? As interest rates rise, prepayments on MBS slow down. Because who's going to pay off their existing mortgage only to take out a new mortgage at a higher interest rate? So prepayments slow down, which means as interest rates rise, the duration of MBS lengthens. Which means their asset portfolio, the duration on the asset portfolio as interest rates were going up, was getting larger and larger. So their asset portfolio was getting more and more sensitive to changes in interest rates, but their liabilities were not. It was a growing problem. Well, they did this because they needed the coupon that they were receiving to be greater than or equal to the deposit rate because they were offering higher deposit rates. So they had to accept duration risk. They ended up with this situation. Duration of the assets, that means the sensitivity to changes in interest rates, not the length of time. I know it's an unfortunate word we use duration that way, but it's not term to maturity, it's the sensitivity of the price to changes in rates. That's called duration. Duration of the assets were greater than the duration of the liabilities. This is how we calculate the duration of equity. Any level 3 candidate will recognize this and perhaps needs a moment to de-stress after seeing that formula. I probably triggered you. You looked at that and you had flashbacks of that particular reading and that particular formula, and you need to hit pause and calm down. It's not an exam again. It's over. You're on the other side. Don't worry about it. For those of you who still have the level 3 exam in front of you, boo, this should scare the hell out of you. But this in itself will tell you exactly what the bank should have been doing. It should have been managing the duration of its equity. That means the sensitivity of its equity to changes in interest rates. And this is the formula for calculating the duration of equity. It is a ratio, your assets divided by your equity times the duration of equity, minus A over E minus 1. This is the same thing as writing liabilities over equity times the duration of liabilities times the ratio of the change in rates. It's, if assets change by 100 basis points, liabilities, yields on liabilities might change by 150 basis points, let's say, something along those lines. So this is a ratio over here. You want to get the duration of your equity lower, which means you want to lower the duration of your assets or raise the duration of your liabilities. Well, they had all this money in deposits. So the thinking at that time should have been, well, how do we move that into duration? How do we add duration to those liabilities? Well, the venture-backed firms that are holding that money aren't going to take duration risk because they need that money. That's their funding money, so they're not about to gamble with their funding money. They're not about to do that, which means they're going to want something with no duration risk at all. Maybe you can put them in different securities like term deposits or something like that, but non-marketable term deposit is not going to have any price risk with it, so it's not going to help very much. The big thing was right here. They should have been looking at how we reduce the duration of the assets well before this all started, because what was the most telegraphed trade in the market last January? Heck, last December, if you go back to December of 2021, before 2022 even started, I think the last market update I put out in December of 2021 said short duration. Short duration. The Fed is going to be raising rates this year. Short duration. And I had put out a trade where when TLT was still sitting at about 160, I said sell the 135 calls on TLT. Sell the in-the-money calls, because as TLT drops, you'll make all that money. It's better than buying the put. Sell the call. They should have seen this coming. And in their disclosure for the end of 2022, SIVB says that they do have the ability to hedge, that they do have the ability to use interest rate products to hedge. Well, every mortgage REIT hedges the interest rate risk associated with what they have. They could have hedged. They could have used interest rate swaps, or they could have hedged. They could have done it. They should have seen that and said, well, for 2022, we should reduce the duration of our equity by reducing the duration of our assets. However, they reached for return. They reached for return because, well, you got to make those numbers, right? You don't want to hit to your stock, so you got to make the numbers, so you reach for return. And this is what played out over the course of the year. VC investment slowed. Well, that was their deposits, because when a target company gets a Series A or a Series B, deposits come into the bank. Deposits come into the bank, but the portfolio companies are mostly cash burn, so deposits are going out. So as long as that continues on, deposits coming in at a good pace, deposits going out because of cash burn, you're okay. But VC investment slowed. All this different series slowed, so deposits coming in dropped. However, the client companies, which are mostly cash burn companies, deposits out did not drop. Well, at some point, you got to sell your assets to meet all of that cash going out. So they had plans. They were selling their available for sale securities up to that point from January 1st to Wednesday, and then Wednesday they announced that, hey, we're going to sell the rest. Sell the available for sale assets to meet cash out needs, which will produce actual losses, which will reduce equity. And when you reduce the equity, you're underwater on your ratios. You need to raise equity, which is what that $2.25 billion equity raise they announced Wednesday after the close was going to do. Less than 24 hours later, it was canceled. And less than 24 hours later, regulators seized the bank. But the problem was right here. Duration of equity. They should have, at the beginning of last year, said, listen, we got a bit of a problem. Our liabilities have a duration of almost zero, but our assets have significant duration. And it is well telegraphed and well known that the Fed is going to be raising interest rates this year. Who cares how much? Who cares that you couldn't forecast 5%? Last year at this time, I didn't think 5% was a reality. I thought, well, they might go to 3%. I thought the 10-year would cap at 3% last January. Still going from interest rates, the Fed target rate going from 0 to 3% is a big deal. I would have stepped in, and in my portfolio I did. You want to be short duration when something like that is going on. They should have been lowering the duration of the equity, which means lowering the duration of the assets, but based on 2022, I see no indication in their statements for Q4 of 2022 that they did any of that stuff. Okay, this is the most recent filing with the SEC. Let me just get rid of these tabs at the top here. Investment securities total 120 billion at December 31st, a decrease of 7.9 billion or 6.2% compared to 128 billion at December 21st. So they say that it's comprised of two portfolios, an AFS securities portfolio that's available for sale, which is listed on the balance sheet at fair value, and a held to maturities security portfolio, which is listed on the balance sheet at its carrying cost. Its carrying cost being its amortized cost. Because if you buy a bond at a premium, it amortizes down to par over time. And if you buy a bond at a discount, it amortizes up to par over time. And you amortize using something called the effective interest rate method, which means you decrease or increase the security adjusted for the coupon. You manage the price based on what the original yield to maturity you bought it at, which means any change in the yield to maturity doesn't affect the carrying value on the balance sheet of the asset. Any changes are reflected in other comprehensive income, doesn't hit net income. So here is their AFS securities at fair value, because that is what they're listed at. Notice that it says here HTM, held to maturity securities at net carrying value being the amortized cost. And we see they had U.S. Treasury securities and U.S. agency debentures, and quite a bit here in residential MBS. Agency issued MBS and agency issued CMO, fixed rate, and agency issued CMBS. All default risk free, but not interest rate risk free. So it gives you the total they had here, 26,069. And I will read you a statement from page 5 of their PowerPoint presentation they released Wednesday night. So they had been selling some of their available for sale securities from January 1st to the time they released this, and there had been more fair value losses associated with this portfolio. Bullet point number 2 from page 5, we have sold, not we will sell. In the screen before I made an indication that they plan to sell their available for sale securities. They have sold. We have sold substantially all of our available for sale securities portfolio with the intention of reinvesting the proceeds, and commenced an underwritten public offering seeking to raise approximately 2.25 billion between common equity and mandatory convertible preferred shares. And then if you go to page 6, they give you some details on the portfolio sale. 21 billion securities sold were U.S. Treasuries and agency securities. The yield of the securities sold was 1.79%, a 3.6-year duration. So you can see the duration mismatch. Their deposits have a duration of 0. These have a duration of 3.6. A preliminary estimated realized loss, 1.8 billion after tax, which means the loss was greater before tax. So they've wiped out this. Then you have the held to maturity securities. Let's have a look at those. Here is another part of the filing. Financial instruments not carried at fair value. And these are pretty much your held to maturity securities here. So you see your cash and equivalents. Well, they'll have no interest rate sensitivity. There's your held to maturity securities. Carrying amount 91 billion. They could sell them for 76,169. 91 billion down to 76 billion. After you take the hit on the available for sale portfolio, if you don't raise the equity, you now have negative equity when you consider this 15 billion, you now have negative equity. That is the definition of insolvency. And then they have some other securities here, net loans 73 that are carried at 74.6. That's also questionable, is it? 74.6. Look at their liabilities here, short-term borrowings, right? You want to see that their liabilities dropped by as much. You have 1991 that went to 76, a drop of 15 roughly. Can we get a drop of 15 here? Short-term borrowings, well, it's going to have no interest rate risk because short-term borrowings are in fact short-term with a duration of almost zero. Non-maturity deposits, non-maturity, that's demand deposits, non-maturity means zero duration, no sensitivity to interest rates. Look at the carrying amount. So the first one is carrying amount and estimated fair value under total here. It's the same. Here's where they did have some liabilities that were interest rate sensitive, right? This one here is the time deposits, 6.6 billion down to 6.4. This one here, the advances, nothing here, but here's all their notes, right? The 3.5 down to the 1.8, and then they have floating rate notes that are due. 349 dropped to 337, 496 dropped to 412, 495 dropped to 364. They should have had more of this stuff. They should have had more of this because as the asset portfolio adjusts to rising interest rates, their liabilities would adjust to rising interest rates, which means their equity would have very low sensitivity to changes in rates, because a dollar drop in assets would be met by almost a dollar drop in liabilities in terms of fair value. And if that happens, then nothing hits the income statement because you've had no changes on net between the assets and the liabilities so that you have stability in your equity. I mean, they could have looked at this and said, hey, wait a minute here. Look at this. The majority of our liabilities, the 13.5 billion, the 166.4 billion have no sensitivity to interest rates, but this 91 billion has huge sensitivity to interest rates. Now that on its own doesn't seem like it's a big deal, but combine that with knowledge of your customer, that your customers are primarily the venture capital industry and venture capital financed firms, and you're in the business of dealing with these customers. You should know that when interest rates go up, venture financing drops, which means money coming into your client portfolios was going to decrease, but these are cash burn companies. So that cash outflow would have continued to happen. You should have seen this a year ago. If you have the PowerPoint presentation, I want you to scroll down to the management team. They're on page 27. Where they talk about their strong, seasoned management team. This jumped out at me like nothing else. I'm looking down at who these people are, and you see the chief financial officer has been there for 5 years. The president has been there for 29 years. Should have known better. 29 years. You went through the dot-com. You went through the financial crisis. You went through COVID. That you didn't anticipate that this was going to become an issue, that you were going to have some liquidity issue because of the change in the behavior of the type of customers you have. What are you doing, right? What got me was if you look at the third row, second one over, Kim Olson. She is the chief risk officer, because my mind right away said this is a failure of risk management. Who's responsible? Kim Olson, Chief Risk Officer, joined SVB in 2022. So you do a little bit more digging, and they didn't have a Chief Risk Officer in place for months until they hired her, and they just brought her on, and suddenly this, right? You didn't have a Chief Risk Officer for months before this happened. You have a seasoned CEO, 29 years at SVB, that didn't see this coming. This is the contractor building houses in Texas, being told that a tornado is 24 hours away and he needs to secure as much as he can and get his people out of there, and says, no, we're good. That's what this is. I can't see this. It's so glaring that, if you told me a year ago, hey, listen, here's the duration of your liabilities, here's the duration of your assets, and this is the customer profile you have. The money coming in for Series A, Series B is going to dry up. You know it has. It did in 2000. It did in 2007. It did in 2020. It's going to do the same thing again. Interest rates are going up. What do you want to do? Well, let's lower the duration of our assets now. Let's do something. Can we use derivatives? Yes, we can. Oh, wow. Hold my beer. Give me the computer for a couple of minutes. I'll take care of this. They could have done something. This was a failure of risk management. It's not a rising interest rate problem. Why do I say that? You can say, well, yeah, but it was the rising interest rates that did it. Yes, but that's part of the landscape. If you go hiking in the mountains of Colorado, expect at some time to run into a bear or a cougar. That's part of the landscape. You can't blame the bear or the cougar. That's where they live. You went hiking there. That's part of the landscape. If you're building homes in Texas, you have to expect it. Every now and then you're going to have to get the hell out of there because a storm is coming that could destroy things. If you're working on an oil rig in the Gulf of Mexico, you have to expect that every now and then a hurricane is going to come along. It's part of the landscape. So to say, oh, it was the Fed increasing rates that broke things, that's your job though. That's part of the landscape. That's your job. There's even a formula for it. The duration of equity equals, and it tells you there's even a formula for it. So I can't see how we can blame the Fed for all of this when they quite rightly telegraphed all of 2022. What did every Fed official say? We're raising rates, and the market didn't believe them. The market fought them. Look at the July rally and the Jackson Hole speech that came out. Fed official doesn't just step out and talk like that unless he's trying to tell the market, listen, you're messing up. We're dead serious on this. We're raising rates. And to not have a chief risk officer and to not take any risk management on this, to misunderstand the nature of your client base so much, I don't know how you can't not place the majority of the blame on management on this one. Okay, so I'm doing this part of the video. This is part one, the market outlook part two. The regular one will be up on Sunday, but I thought this was important enough to do a separate video for. I don't know what's going to happen Sunday. I don't know what's going to happen Monday before they open. But this is the way we left things on Friday in the market. I would expect that there's going to be some kind of announcement before the market opens on Monday to restore confidence and to alleviate concerns, to avoid another run on another bank somewhere. There would have to be, and if there isn't, by 9:30 when that opening bell rings, if there isn't, it's going to be blood red everywhere. On Friday, Pacific Bancorp, this is as of Thursday and Friday. By the time we closed on Friday, Pacific Bancorp was down 54% in 2 days. 2/3 of its loans are tied to real estate. Plus, it is also a lender to VC firms. First Republic Bank was down 29%, real estate and mortgage lending. Signature Bank down 32%. A lot of crypto firm clients. Silvergate is now liquidating. Western Alliance was halted on Friday to suggest that on Monday, when everyone shows up with no announcement that all of this is just going to go back to normal. I don't think so. This is the KRE. This is the regional banking ETF, down 16% in the course of the week. This is 2008 type selling. To be down 16% in 1 week. The KBE, the bank ETF, which has some larger banks in there, along with an overlap of regional banks. There are regional banks in here as well, down 14.4% in 1 week. Canadian banks, it wasn't just limited to the U.S. Canadian banks, and these are big moves for banks in the absence of earnings. They had their earnings, they had their movements, and everything seemed, well, not great, but not terrible, not sell-off terrible, but a Canadian on that one. Bank of Nova Scotia down 6.06% for the week. TD down 5.62% for the week. That's considered probably one of the better managed banks in Canada. TD down 5.62. I sold puts on each of these. IYR, heavy, well, it's real estate, right? It's REITs, heavy interest rate sensitivity there, down 7.08% for the week. Now, you've had rising interest rates all of 2022, and IYR has held up fairly well. You'll recall if you follow the market update for any length of time, you know that I love selling calls on IYR to protect the value of the other REITs I have in my portfolio. I use IYR as a proxy. 7.808% drop. So those calls were, I've done nothing but make calls on these. Every time they go up, I sell calls. They come down, I cover the calls. This was a gift to drop that much in a week, but the REITs that I held all suffered badly as well. XLF down 8.33%. JP Morgan down 6.7%. Unless something is said Monday and something is done Monday before the open, preferably Sunday night, to avoid what would happen on Globex Sunday night and through the night on Sunday night. Unless something is said Monday morning, this will continue. This could get ugly fast. As I've said in market updates before, when problems show up in this sector, they show up all at once. They don't just creep in. You don't just see them coming. They show up all at once. And usually it is something that nobody expected, and it comes out of nowhere. And I gave the analogy of swimming in the ocean. And the ocean is beta. All right, here is the ocean, and here is the shoreline. And the shoreline is U.S. Treasuries. And here is beta. And you're swimming in the ocean, and somebody gets bitten by a shark. Well, you didn't expect that to happen. Is there only one shark? Are there more sharks? How many sharks are there? You can't look around and assess. Your immediate response is run for the shore. You got to run for the shore. So on Friday, if you were watching Treasuries, they went straight up. Yields went straight down. TLT. If you were watching TLT on Friday, it crossed over into 103, then it crossed over into 104, and I thought, well, that's a good day. Then I saw it cross over to 105, and it right into the close. Money was running for safety and running out of the water because they don't know how many other sharks are swimming out there in that water. Maybe there was only that one shark. Maybe there was. Are you going to hang around in the water and figure it out? Look around, look under the water. Let's see, are there any more sharks? Is that shark coming from me? Is that the only thing? Did it bite that person and only that person because it didn't like that particular person, or that person was swimming in its territory? You don't know, so you got to get the hell out of the water. Well, unless the lifeguard comes out Monday before 8:30 and says no sharks in the water, all clear, the belief will be that there's more sharks out there. You can't go back in the water, and anybody left in the water is going to start rushing for the shore. So this, what you saw on Friday, could continue on Monday. So it would be shocking to me if somebody somewhere didn't make an announcement about something to restore confidence in this particular sector ASAP, because a loss of confidence, as you saw in 2008, gets ugly really, really fast. And you have this bank close and that bank close, and then that causes this to happen, and other people get concerned, and then it's just an ugly mess that can't be stopped at that point without the Fed just basically coming in and backstopping everything. And it wouldn't surprise me if the Fed came out on Monday and said that they're opening up lines for all banks. Any bank that needs liquidity, you come and see us. We'll help you out. It wouldn't surprise me if they did something like that. So there it is. I think that's the only story. Right now, CPI is meaningless unless this is taken care of. Nothing else matters at this point. And as I said in previous market updates, when these things show up, that's it. That's nothing else will matter at that point. And so is it worth talking about Powell's trip to Washington? Is it worth talking about the jobs report? No, because none of that means anything for what's going to happen Sunday at 6 when Globex opens and futures start trading. Nothing is going to matter other than this.